Now, there's other ways you can use stop losses. So, say for example, you want to risk no more than $250 in a trade. Well, you're going to jump into this trade here, and if price action starts to bounce against you and it gets you down $250, then you just close the position and tell yourself, there's no reason as to why I got stopped out. That's just the name of the game, and this game is built on a game of probabilities. But over the long haul, over the series of trades, those probabilities are going to play out in my favor because I've back tested enough of this and I've forward tested enough of these potential setups to know that XYZ strategy operates at a 68% win rate over the long haul. I'm going to make more winning trades than I'm going to have losing trades, and I'm going to keep my losses as small as possible by managing how much I'm willing to risk per trade. Now, for me, I believe in managing risk not in terms of points, but in terms of dollars. So if I'm willing to risk $250 a trade, but let's say I know that there's a potential pullback that could potentially stop me out for 30 or 40 points, well, I'm not going to go put on one mini contract because I'm not going to be able to afford that risk. But if I was to trade, let's say, two micros or three micros, then now I can afford to take that trade. I can afford to take that risk. And yes, maybe the profit is going to be a little bit smaller than if you were trading something like one mini contract, but the losses are going to be much more manageable and you're going to be able to stay and remain focused and continue to stay in this business.